G'day all, welcome back to Money in the Tank, EP 24.
Yeah, EP 24.
Yeah, sorry we missed last week, but hopefully the episode 23 tied you all over. It was a long one with Brad and great chat about all things crypto. So if you missed that one, make sure you filter back to get it because we've had some really good feedback and it's been terrific to get that feedback. And I'm not sure if Arnie, if you got a bit as well, but we'll definitely look to get Brad back on again.
Yeah, got some, and I've got an update for the tankers on my my altcoin, my shitcoin. So hey, I'll fill you in, but I'll make sure I do that before we get into the main story, just so I don't forget, because it's pretty funny.
Awesome.
Anyway, so it's all. I'm Arnie, tax professional, and Joel.
Yeah, Joel Seach, principal advisor, Harpel Financial Group. Great to be here and great to be chatting with you again, Arnie. And today we're going to cover off, a bunch of cool, a bunch of interesting stories in the finance world, such as Evergrande, and there's some interesting things that came out about super a couple of weeks ago, which I'll touch on as well. And Arnie, I think you've got a few really good Q&As today also.
Yeah, got a few Q&As, and also I should mention, Jolly, that should we do Rifkin's first and then I'll talk about the crypto situation, or do you want to?
Let's do Rifkin's. Let's get Rifkin's done. So, okay. Rifkin's rules. I love eating so much. I never get hungry. I don't even know what it feels like to be hungry as I have never experienced it. So.
As he's never experienced being hungry.
There you go. Yeah,
he was a bit of a chubby man in his older, as he aged, Rifkin. So yeah, he definitely liked the finer things.
There you go. And below that, he's got, if becoming a vegetarian would ensure no more animals would be killed, I would. So there you go.
Oh, that's a interesting moral and ethical thing. Just quick side note, Kate and I watched that documentary recently, Game Changers. Interesting documentary about plant-based food versus animal-based. If you've seen it, yeah. Okay, so this crypto situation, you guys prompted me last week and I forgot to talk about it. So I went back and checked this week with the guy who organised the chess tournament.
Yep.
And as soon as I contacted him, he started apologising profusely and said, "I'm so sorry. What has occurred?" And I should say the name of this cryptocurrency was YYC, which stands for the YOLO Yacht Club. The YOLO Yacht Club. Anyway, he goes, the bloke who started it and had been getting people to mine it has just basically done a rug pull and sold off something like 75 or 80% of the coins and just taken a couple grand gain. So this guy's made a couple grand, and I think this coin's been going for over a year, and he's just left everyone else who's holding it, just bag holders, with a worthless coin. So the bloke said, I'm not even going to move it to the Binance Smart Chain anymore. I know I said I'd give you 10 million, which at the time was worth $5. He said, but the guy's just done a runner with our money, and I'm sorry about that, mate.
That's so good.
I feel like if we're comparing my crypto situation to yours, mate, you're the solid winner here.
What a great finish to that story, though. What a great knot on the tail at the end.
I didn't even take control of the 10 million shit coins. It's gone.
So good. I guess it's a great learning lesson for our listeners about the very unregulated market of the crypto space.
A lot of cowboys. It's the Wild West, isn't it? So
indeed. So I think the crypto market's taken a bit of a hit this last week, Dog. I think we were down yesterday. I looked, it's up a little bit today, but it's a long-term play anyway, mate. But it's a bit of a roller coaster in the markets at the moment. Also, like the stock market too.
Yeah, I think this might even tie into the Evergrande story. But before we get to the Evergrande story, I've got a few quick news items. First one was Jay Powell of the Federal Reserve in the USA said that tapering is going to happen, and they think the timeline is that it might conclude in the middle of next year. But he was pretty quick to say that they can slow that down or they can make it faster as needed, and they're just going to see how they go. At the moment, what they're worried about is the bottlenecks or the shortages in their economy in certain sectors, like semiconductors is a good example. So they're sort of waiting on that. But he did reference the Evergrande situation, Jolie, and said, and I know we're going to get into this, but he basically said that Chinese government working hard to keep it under control. They've put these structures in place for highly leveraged companies, and he thinks at the moment there's not a lot of direct exposure to USA companies. So he's not too worried about that. That's sort of what he inferred. And the last news item, there's a couple of other ones. Premier Investment. So this is Solomon Lew's company, Australian company, posted 100% year-over-year rise in their net profit. So they went up 4.4% in the last trading session. I think that was yesterday. So these guys own brands like Just Jeans, Peter Alexander, JJ's, etc. So they're doing very well for themselves in lockdown. And there's a bit of controversy with them taking JobKeeper money, and I think they said they're going to pay it back, or some of it. Well, I can't remember part of it or all of it. But yeah, those are the two news items I wanted to touch on before we jump into the main one.
Yeah, some super interesting ones, and we'll definitely touch on the Evergrande stuff at the moment. In a moment, and the other couple that I was just thinking of then that we mentioned at the top of the podcast was in relation to, well, firstly, property. So property's back online again, in Victoria with the opens and whatnot. So I think they had a very high clearance rate of 95% on the weekend. So that's back sort of happening again. They're able to do inspections even though limited by number.
Mm-hmm.
And then the superannuation came out a couple of weeks ago. Check the news reports. There's about 13 super funds that got sort of named and shamed, so to speak, in the worst performers list. So they're different platforms. So they're across all the different industries, and there's names you may have heard of, may not have heard of. But very important to note that they use it. There's a bit of a ruling around what they're benchmarking the underperformance against, and also what the costs are associated with the platform itself. So keep an eye out for that and make sure your super's sort of not named in there. And if it continually gets named, then you've got some issues to be concerned about in terms of potentially looking at other options. And the mandate of that, anyways, you will get notified via mail or email to say that your fund has underperformed from the actual provider itself, and suggesting that you roll out of that certain investment. So pretty uncharted territory, and quite, I think, good news on the overall superannuation front to keep platforms and funds honest and keep them accountable and proactive, because sometimes in the superannuation space, especially with younger people, younger clients, you can be a little bit disengaged because it is such a long-term play. But if you keep an eye on those things now, it can pay big dividends for you in the long run if you are with a fund that's doing above the benchmark or outperforming, or if you're constantly with one that's underperforming, it can make a big difference. And also the asset allocation as well. They're looking at the MySupers at the moment, so the MySuper balanced options, and I think they'll broaden that as it all progresses. So keep an eye out for that. Keep an eye out for that list. And if your super's one of them, then you should get something in the mail to sort of recommend options to do with it.
I saw this, Jolie, and this was year-over-year performance, wasn't it? So
yeah. Correct,
I feel like it is a good thing, but my own personal thoughts are it's very harsh to judge a super fund year over year, because they're long-term investments. Like the 10-year return may be way better than other funds. So I guess look at all of that.
Correct. Yeah, you got to be really mindful of that. So the historical return as well. So don't jump ship too early, but do your research, do your investigation, speak with professionals.
Well, for the tankers, if you want to look yourself, a good place to check is CanStar. CanStar, you can check out I think it's the 1, 3, 5, 7-year performance of most funds. So go and check it out yourself as well.
And always general in nature. Whenever we're talking about these different investments in different areas of investing and finance, always general in nature, and always seek personal advice and guidance whenever you're looking at your own situation. Of course, Arnie.
That's it. And before we get into Evergrande, if you guys want to give us a like or a subscribe or a comment on the YouTube video, that would help us. And if you are subscribed to us, please click the notification bell so you get alerted when we bring out a new pod and a new video.
Get after it, guys. Get after it, tankers. Send the love. Send the love.
So Evergrande, do you want me to give overview, Jolly, or do you want to give a quick overview?
Yeah, give an overview, mate, and I'll just jump in with some tidbits that I've picked up along the way too, which might be of interest to the listeners.
Yeah, I'll give a bit of an overview. So there was this policy introduced by the Chinese government, and it's quite a while ago. I think it was introduced maybe over a year ago. Just
firstly, Arnie, just a brief background for the listeners on what Evergrande is, in case they may not have heard of it. So it's a huge global real estate group based out of China. So it owns about 1,300 building projects in 280 cities across China. It was founded by Chinese steel executive Zhu Yiying. Don't crucify me if we have any Mandarin listeners out there. It's Southern China 1996, so it's the second biggest property developed by sales in China. And it's a huge business. It's I think debt's assets or debt pile about $300 billion of debt. It's some analysis and mentioning Evergrande is potentially now one of the world's most indebted real estate developers. So that's sort of the background to Evergrande, Arnie.
Yeah, thanks, mate. Good call. I didn't even think about diving into exactly what it was. I think because I guess it's such big news in our world that I took it for granted. But yeah, so there was this policy implemented in China about a year ago where they were trying to, I guess, cut or curb like how leveraged these firms are. So they've been, like the main part of this policy that's important is they've got these 3 red lines, and the 3 red lines are your liabilities to assets need to be below 70%, your net leverage, so that's your net debt to EBITDA or earnings before interest, tax, depreciation, amortization needs to be less than 100%. And your cash to your short-term debt needs to be greater than 1, i.e. you need to have enough cash in hand to cover 12 months worth of debt, basically. And off the back of implementing this, these structures, but along with the broader policy, they had some defaults occur over the last year. And some of those defaults were in state-owned entities, importantly. So even government-owned entities were being allowed to default if they weren't meeting these 3, they call them the 3 red lines. So they did this because they were trying to stop a financial crisis occurring or trying to curtail a crisis occurring in the real estate sector. And the real estate sector being, construction and property development, but also the people that are buying it is typically households. So what is just in like a quick sort of 5-minute explain like I'm 5, what companies like Evergrande have been accused of is bidding up these land prices way above the market value, not caring because they're going to sell them off to when I say sell them off, they're going to sell them to households, and then that risk is going to transfer to the banks that are financing that transaction, and also the holder, which is the household. So interestingly, household debt at the start of 2021 as a percentage of the Chinese GDP was 62%. So it was ridiculously high, higher than most households can service, especially if you see something like what's occurring and there's a run and these properties are either not sold but not being built, or have maybe been partially being built but are kind of not worth as much as people thought they were going to be worth. So it's causing basically a credit collapse, and it sort of prompted the Chinese government to start taking action, and they've started putting stimulus into the market. So that's the basic overview, Jolie, of what's occurred.
And some other things that sort of jumped out at us in some articles that I was going through was Evergrande also put pressure on its staff to lend it money. So the loans were presented as high interest investment schemes, but those who didn't take part risk losing their bonuses, which is, a pretty significant one. And then it says this month, Evergrande actually stopped paying back its employees. So they're gathering on the streets outside the company's offices, demanding their money back. So, pretty significant stuff there. And I guess one of the other things that potentially caused some of the issues to occur was they've continued to grow, take on debt, and grow, take on debt, and it's sort of when Arnie, you mentioned some of those changes with the red lines in terms of the government started intervening. It then started changing regulation, and then the trouble started to set in, and they were having to try to sell some of these properties that they may be accounted for in terms of a sale price at lower values, and then the consumers started losing a bit of confidence in that, and it started spiraling from there. And then I guess that digs into Arnie, you probably can touch on is sort of how that then impacts the markets from that.
Yeah, mate. Well, you've hit the nail on the head. And interestingly, I think they were saying that Evergrande alone, so bear in mind that Evergrande is a large one, but not the only one of these companies that's in this kind of trouble. Evergrande alone has an order book of 1.7 million residential units that are down paid for, like have been the down payment on them, but have not been finished. So I think one of the big issues which has come out of this, and there's a brilliant Twitter user, I'll try and give you his Twitter handle. It's Inate Carlo Dos. Maybe I'll try and drop a picture of it. But he was saying that one of the big problems which people aren't talking about here is capital misallocation. So the fact that all of the capital in the country, or like a lot of the capital, is sort of disproportionately going towards the real estate sector and construction, means that they're not investing in other sectors which would be actually beneficial to their GDP long term. They're basically just propping up their GDP with this real estate and construction markets. So what was the question you asked, Jolie?
Well, I guess it sort of then lends itself to how does that then impact the markets? Like overall, people refer to it like, is there potential Lehman Brothers impact where there's bad debt sort of siphoned around the world? Some of the information that comes out is there's a lot of state-owned or bank Chinese institutional-owned debt on that's lent out to a company like Evergrande, but then there's bondholders as well that have taken an assessment to say, we'll lend Evergrande $100 million and they'll pay us a coupon bond rate. And that's been coming in the news now. There was the worry that they may not be able to meet that repayment, which effectively is a big deal in the investment in the bond world, to say that you're going to default on a coupon payment.
So you're speaking broadly about contagion, right? Like, what are the contagion risks that if this occurs, what's going to happen? And it's a really good point, because something that we've already seen, and it was again pointed out by this Twitter user, well, it's the first time I saw it, was that if you look over the last sort of month, or maybe the last couple of months, maybe the last quarter, in the Aussie mining sector, big miners who, majority mine iron ore and then supply a lot of it to the Chinese market, have taken big hits. So I think if you go look at the 1-year chart from Rio Tinto, BHP, or Fortescue Metals Group, and you look at from the all-time highs, which occurred, in the last year or so, and look to now, I think between the three of them, one of them's down like 25%, one's down about 30%, and one's down about 40%. So they've all taken huge hits off this. And even though they've rallied in the last couple of days off the back of, I guess, some news that Evergrande has paid some of their debt, but there's more debt maturing end of this week and early next week. And then also the Chinese government came out, and I think they said that they're going to try and make whole any Chinese investors, but I think they implied that they're not going to make whole any foreign investors, which is why I sort of started with that news item about Jay Powell of the Federal Reserve in America, saying that he doesn't see a lot of direct exposure in the American markets. So there will be some.
I've got the chart here, Arnie, in US dollars. So you're pretty spot on. As at about May 13th, it hit sort of its peak around $230 per ton, isn't it? Ton of iron ore.
Yep.
And that was actually around the time, if you remember, the Australian budget came out. They were talking about how they were going to utilise the iron ore price and whatnot to do with their budget. But they actually smartly, they sort of guesstimated on a very, very conservative number when they're talking forecasting. So, they'll probably thinking they did that now, because their figures would be way out. And now it's down as it yesterday to about $103.
That's a rebound, Jolie. On Monday of this week, it was down to $90 a ton for iron ore, and that's 60% off the highs that you're mentioning. So from a commodity perspective, but it's there's contagion, and then I guess the next question becomes, where else are you going to see contagion spreading from a potential collapse in these some of these massive companies in China? So we don't know, you and I, what's going to happen, and I guess the fact that the Chinese government has said they're going to do a sort of a soft bailout and bail out the Chinese holders, or like anyone who's got like sort of a Chinese connection to any kind of risk of this default, I think they're going to try and like do a soft landing for them, but they're going to let any big overseas interests just have to float on their own. And I believe there was news, and like maybe go check this out yourself, Tankers, because I haven't got the article in front of me, but I believe there was news that BlackRock, which is one of the biggest private investment firms in the world, and they own a lot of real estate, has started selling off all of their Chinese property assets and will be pulling out of China as a result. And I think they held a certain amount of bonds from Evergrande as well, something like $400 million USD worth.
Very interesting. And that, again, lends itself, when we talk about diversification, and we've done so over many podcasts, is because if you're hitching all your investments to one particular area that you may not have a significant amount of control over, like this, then you're potentially then setting yourself up for, a significant hit to your portfolio. So I think Evergrande's share price has dropped about 80% over the year. And it owes money to about 170 domestic banks, it says, and 120 other financial firms. So if the company defaults completely, there'll be consequences for the banking system, and potentially broader impacts. I guess in terms of the short answer to things, it's time will tell as to how it progresses over time. I think there's probably a bit more hysteria at the start of the week. It seems to have settled down a bit now, and Chinese government may come in to intervene and ensure that your regular consumers aren't, impacted too drastically from it, as you mentioned. But even a really interesting article I read during the week this week was when we talk about diversification, the reason we talk about 50-50 and all those things for a bit of fun. But Mike, when you dig into the micro of it, we talk about iron ore prices, sort of impacts iron ore prices, which then filters through to a major economy. A major part of the economy in WA is iron ore and resources. So then potentially the property market there, that potentially has a big impact on the property market from the iron ore prices and the potential lack of the price growth and the potential implications of jobs and employment and those things, which then flows onto property. So that's what we talk about. When you go macro and you dig into the specifics, it can all have all these different ramifications across the world.
It could absolutely affect us, and that's why we're keeping all eyes on this. And it, as you rightly pointed out, Joel, it could affect real estate in Australia. It could affect financial markets in Australia. It could be something like, depending on what occurs and how they react to this. I don't want to be like a fear monger, but like the fear is that something like a GFC will occur, right? Like something like a global financial crisis will occur off the back of these over-leveraged companies in China. And then it's about how exposed international companies in other markets are to these bonds from these property developers. So it's a good point to sort of, dot the I's and cross the T's on this story, because we have some good Q&A, and some of the Q&A directly relates to this. So I might hit you with the first one, Joel, and this comes from Carolyn. And the question is it too late to invest in lithium or companies that, are in the lithium space?
Yeah, and we were chatting off air about this one, Arnie, and you made some good points in terms of some of the lithium prices are down a fair bit of late, aren't they? So there's potentially a buy-in strategy there if you're wanting to get in. And I guess, again, putting the advisor hat on diversification side of things is you potentially wouldn't want to have your whole portfolio largely made up of just lithium, but as a portion of it, if you feel there's scope for that kind of area and resource to do well over time with the battery storage, the electric vehicle push, if there's more scope for improvement in that area over the next 5-10 years, you always talk about a long-term play. If it was a short-term play, it's anyone's guess. You don't know. It could track backwards more. It could go up really quickly. So, but for the future, in terms of if you feel like there's going to be growth in that area, in that sector, then it'd be a sensible thing to have a look at to say, well, does this fit into my medium to long-term type portfolio, given all those other factors that I mentioned just before?
Yeah, mate, I've looked into lithium before. I actually looked into it in early 2020, and there was a particular penny stock I looked into called Neo Metals. This is, again, general in nature, so don't just go out and buy Neo Metals. But when I looked at it, Jolie, it was 26 cents a share, very cheap penny stock, and now it's up at around 90 cents a share. So I'm kicking myself I didn't put any money into it. The reason I didn't is because there's a lot of risk there. They haven't got a revenue stream at the moment, but they've got a technology which they're pioneering and they're trying to come online, which is about the recycling of lithium. So from any source they can get it, old batteries, anywhere, they reckon they've got this process where they can split out the rare earth metals that are involved in the battery process. So not just lithium being one, but there's cobalt and nickel. And then they think they can refine it back to a battery grade lithium ready to resell to people that need it. So, for example, electric cars or battery storage, they think they can get the quality of lithium needed to then sell it back. So that's why it's an interesting company. But just looking at some of those blue chip companies we talked about before, BHP, Rio, Fortescue, a lot of those companies, they're large market cap companies with, I haven't gone and had a look at the balance sheet or anything, but I would say that they're pretty safe. Like, they're massive Australian companies. So if you go and have a look at how much they've dropped from their all-time high off the back of this iron ore, I don't want to call it a crisis, but whatever you call this Evergrande saga, it could potentially be a good time in the near future, now or in the near future, to invest for the long term, because I do feel like these companies that produce iron ore are also heavily in the copper mining industry, and lithium is the byproduct of these mining processes. So yeah, it could be a good time if you want to capitalize on the electric vehicle boom or the energy storage boom that people think is coming in the next 10, 20 years, then yeah, these companies could be a good place.
Good point.
So the second question we got was from Michelle, and it does tie into Evergrande again in an odd way. And her question was, is cryptocurrency, I should mention that she wanted this directed to Brad, and we will forward this question to Brad and get his official answer, but this is our crack at it. Is cryptocurrency like mortgage-backed securities? Could it burst, and could it cause something like the GFC? So again, you and me, Jolly, were chatting about this off air before we started. And interestingly, there is a link between the cryptocurrency Tether, which is pegged to the US dollar, and Evergrande. And again, I'm not an expert in crypto, so this is a bit of an odd one for me, but I had a look at it. And I think the basic gist of what people are purporting, so this is all conspiracy, none of this is confirmed fact. People are purporting that, it is fact that Tether has said that their reserves, half of their reserves, are made up of commercial paper, short-term commercial paper. And they had been probed on interviews on like CNBC and stuff, asking them, well, where is this commercial paper from? And they've been directly asked, is it from China? And they refuse to sort of answer this question. And then there's sort of been a few people putting pieces together. And I think there was a Fitch, which is a ratings agency, came out with a paper saying that there could be some risk in the stablecoin markets to the financial sector. And they're basically saying that if Tether has commercial paper out with companies like Evergrande or other property developers in China that are risky, and for whatever reason now that there's a bit of a crackdown from their government and some of them are defaulting, that means that if Tether needed those reserves to come home, they're not going to be able to get their money back because these companies have got, they're defaulting, they're bankrupt, there's no liquidity there. So what that potentially means is if there's a run on Tether, people try and pull all their money out of Tether all at once, then they don't have the reserves on hand to then pay that, which means they're not going to be able to pay these people, and Tether's going to go to zero and be worthless. So that's sort of the implication there. Will that event be enough to trigger something like a global financial crisis? It depends on how exposed people are and how leveraged they are. And I think, and we need Brad's advice on this, because I think there's a link between Tether and Bitcoin, and I don't understand what it is. But it's an interesting question, Michelle. And again, it sort of stems back to what Jolly was talking about before, contagion. It may not be the sole catalyst to cause a global financial crisis, but if it knocks over enough dominoes, it very well could be.
Great question. Well answered, Arnie.
Thanks, mate. Yeah, and the last one, which I'll give to you, Joel, and maybe we'll both tackle it together, was this is also from Carolyn. So, is it too late to invest in rapid antigen testing companies? So things like rapid testing, we don't really see it here in the Aussie market, but I know in other markets they're using these rapid tests to determine if you've got COVID or not. Yeah,
it's a great question, and it's one of those things that when you talk about the market and you talk about news coming to market, has that share price already factored in that kind of news, if that makes sense, Carolyn? Because essentially when people in the general public start hearing about something, the market has usually factored that in because your big hedge fund managers, your big instos are potentially already, got some inside word or understanding that this is going to come into play. And as the market already shifted and moved so quickly and so rapidly, by the time, it comes around to you to have an option to look to buy, or the news hits your desk, is it then already, factored in? Because The market's a very volatile beast, and it forecasts and proactively looks into, a year, a year and a half down the track, which was what we were talking about with Jerome Powell's tapering. They're thinking about, okay, well, how long is it going to be till the tapering, comes off, and when will they start looking at interest rate rises? And the market essentially is factoring in those kind of futuristic events to occur. So rapid antigen testing, it could well have a big part to play moving forward in the future. From an event side of things, sporting events, and all those types of things. How do you know? It's fairly challenging to see from a forecast perspective, but it could well have some more room to run and be part of the future. But it could also very well be one that says, oh, well, the virus changes so frequently. If you have the bulk of people have vaccinated or they've got their passport, we're not going to bother about checking. That's going to be the interesting thing to come out and play from there.
I had a bit of a look at which companies are developing or have these rapid antigen tests ready, Jolie. And I actually think, and I need to confirm this, but I think it was actually developed in Melbourne, Australia. So shout out to our hometown. But there are some big mobs and some smaller mobs who are developing or have regulatory approval to produce these tests. So like a massive one, like for example, is 3M. 3M, you see them, they make all sorts of different gear. Investing in a company like 3M, you would suspect that the price isn't moving much because they may have a rapid antigen test on the way. But if you're looking at a smaller cap company that's only involved in something like this and it might make or break their company, then again, you might get a high upside, but you might also get a lot of risk there that they won't. Either they might bring it to market, but that may not be the first mover, or someone might prefer a different test for whatever reason. So is it too late? Hard to say. I don't think it's too late to invest in companies that make them. To actually get a good return out of it, I don't know if it's a good, for me, my own personal thought is I don't think I'd be looking to this as
from a risk reward type play. Yeah. I get you. I hear you. And, just you talking then just made me think back to when we had this pandemic occur. The prices of everything went backwards, but then you saw your tech stocks like your Zoom and your Microsoft and those ones that everyone was going to be using more of just rapidly shot up. So, it's sort of like, well, if you're sort of getting towards the tail end of that, do you think there's still room to move in that area? So rapid antigen testing has been sort of, on the move, and this virus is always moving, but has it been around for a fair while now? Is it factored into the prices already? And will there be further use of it and more demand of it in the future? That's sort of anyone's guess, I guess. It'll differ country to country.
Interesting one. Yeah, no, good questions, and we appreciate them. So keep them coming.
Money in the Tank. Coming. How do they get us, Arnie?
They can get us at Facebook, Twitter, Instagram, YouTube, and it's at Money in the Tank for all of those. And we prefer the questions to come through the YouTube comments, but any way you get them to us is fine.
Yep. Had a couple of listeners hit us up this week with some takes us to the favourite section of the podcast for everyone is the 50-50, this or that, either or.
What's your choice, debit or credit?
And for those new to the podcast, the reason we do that is we did reference it earlier in the pod today is you've got all different investment choices when it comes to the financial world and different alternatives to invest in one area or another or both or a mixture. Same thing with life choices. So we love touching on life choices and talk about some of the choices you have in the certain everyday life that we live. So the questions come in. I've got one shout out to Loma Loams. So shout out. Came up with a really good one the other week, and I actually had to message him back to say just expand on that for us a bit, so we need to get it spot on. His question was, do you prefer a new towel or an old towel?
Oh, okay. Well,
and if you like, I'll give you the extra background on it.
Yeah.
He says an older towel that's maybe a few weeks old or a month old, or one that's a newer towel and sort of fresh out the box sort of thing. So we're talking an older towel has to be at least kind of, let's say, a couple of months old, or a newer towel just fresh out the box.
I always prefer an older towel, and I actually find it to be one of those like life's mild annoyances that I have to get a new towel and use it a couple of times to sort of make it rough up a little bit on my body. Because when you get a new towel, there's like, even after you wash them, there's like little bits of fur that fall off and it feels too smooth and feels like the water's not soaking up properly. So I prefer an older towel, Jolly. What about you?
Yeah, I'm on the same track with you, mate. Initially, I thought, new towels are good, but you then think back to when it's cold and winter and you get that new towel on you're wiping yourself and it still feels really cold. And it's like, this thing's not soaking up well. So the new towels, I don't know if there's any particular companies that do a new towel that doesn't have that. Mate, great business idea right there. You'd be able to, start off a business of new towel with an old towel feel.
Pretty rough towels. Rough towel.
A roughed-in towel. So, because it's not a great feeling when you get a freshie. It feels soft, but great for when you're dry. But when you're getting that water off, it's got the water pellets all over it, and it's just cold. It's not fun.
What did Loam say? What was his?
I think he actually said the old towel. Yeah, he said the old towel. So, older towel generally dries better, a little bit crusty. A new one's soft but doesn't dry as well. It's a divided debate.
That's funny,
and he said he loved episode 23. So hopefully you appreciate the shout out today. And we had a quick one before from Kenny. Kenny B, self-proclaimed number one listener, Kenny reckons. So
Kenny
hasn't missed an episode, but he threw a quick one out. Souvlaki or kebab?
Suva all day.
Yeah,
all day.
Yeah. I sort of thought, I don't know the difference of them because maybe I tend to have them when I've had a few drinks possibly. So, but then you start to dig into it, and souvlaki is generally a bit of a thicker bread, a bit of a healthier type sort of Greek kind of delicacy, and the kebab can be potentially, depending on where you go, a little bit sloppy at times.
Can be, I think Suva all day, because when I think kebab, I think like Turkish, and don't get me wrong, they're both delicious, but I had to choose one. Yeah, Superman. No, good question, Kenny. Thanks, man.
Love it, Kenny. Self-proclaimed number one fan. We'll get you a badge in the mail, Kenny. Yeah. But thanks for listening today, guys. Thanks for tuning in. Hopefully, some really interesting content there, and we'll keep you guys up to date on all the news items and all the current financial events occurring. And we'll endeavour to get Brad back on as well as another feature guest soon to chat more things crypto and NFTs as well, maybe.
Yeah, and my YOLO yacht club, it's gone. The dreams are dead. So long live the Baron of Bitcoin.
Long live. All right,
cheers, guys. See you, mate.
Take care. Hey, by the way. Go D's.
Go D's.
This is Thursday. We're trying to keep a lid on it. See you guys.
See you, mate.